Hello, everyone. Thanks for joining today's webinar. We are only at 6 o'clock and we're still waiting for some people to join. So let's give it a couple minutes if you don't mind. Thanks for joining on time though. We'll wait a couple minutes and then go from there. Okay, it's already 3 past 6, so let's start. And for those of you who joined on time, thank you very much. And for those of you who just arrived, welcome to today's webinar titled The Power of ETFs, Building Strength in Any Market. Today, we'll be covering three main things. Firstly, going through a primer of what ETFs are and why they provide a superior way of growing your wealth, let's say, versus picking stocks. We'll also talk about how you can use ETFs to build your wealth, and we'll go through some different scenarios, whether you already have a portfolio or whether you're in cash. ETFs can definitely work for you. And because we recently launched our StashAway Explorer product on StashAway, we also wanted to show you how exactly to navigate ETF Explorer, how you can make your first transaction today. So there is also a Q&A box, which I welcome you to use. You can use the Q&A box to ask any questions relating to StashAway or today's content. But also you can use the chat function or the hands up function, whichever you want to use, to participate as well. So I wanted to see how many people here, before we begin, how many people here have actually heard of ETFs before? Okay, couple of you, but not too many. Okay, hands down. And how many of you actually have invested using ETFs before in some way, shape, or form? Okay, so the couple of people who have heard of ETFs have also invested in ETFs. So that's good to see. And for the rest of you, I'm going to presume that you're relatively new to the world of ETFs, right? So let me first say that ETFs are not new. They were a vehicle or a type of security that was launched in the early 90s. And right now, in the US alone, there's over 4,300 ETFs that are listed. So imagine there's on Bursa, there's something like 900 stocks available for you to choose from. In the S&P 500, there's 500 stocks, but in the universe of ETFs, there's 4,300 of them listed in the US alone. So that mind-boggling number tells you that ETFs have a lot of advantages when it comes to using them and investing in either broad indices or asset classes or certain sectors, certain countries, or specific themes they can also be both passively managed and actively managed. It's just such a popular investment vehicle, very similar to stocks in the way that you buy and sell them. But it can be really, really overwhelming. It can be really uh, scary to begin to invest. I think a lot of you here are listening today because maybe you in terms of intent, you definitely want to invest, but maybe you haven't begun. Maybe you find it intimidating to choose stocks. If you tune into the news, you hear things like AI and Nvidia, AMD, but you don't really know how to make heads or tails of it. And you find maybe stock picking a bit too overwhelming and you don't know how to make that first step, right? And you're not alone. A lot of retail traders find it hard to make money in the long term anyway from picking stocks, but also professionals find it hard. This is a visual from Spiva, which is an arm of the S&P 500. Sorry, it's an arm of Standard and Poor's, the indexing and ratings company. And basically, they collect a lot of data for a long time. And this tracking data shows you that 85% of US fund managers don't outperform the S&P 500 over a 10-year span. So that means that, these very smart people were very qualified, very highly paid, day in, day out, they're professionals, right? And they're trying to beat their index, and the index is S&P 500. And even they, don't beat them over a 10-year period. The number rises the longer you track the data. So actually, I think if it's over a 15-year period, something like 89%, almost 90% of people, of professional fund managers actually don't beat the S&P 500, right? Even though they manage stocks professionally. So actually, it's much better to hold an ETF of, let's say, the S&P 500 in totality, as opposed to trying to pick stocks and use that as your primary vehicle of growing your wealth. So just definitionally, ETFs is a basket of stocks or bonds really designed to give you access to instant diversification in a cheap and easy way. So just breaking it down, if you were to start investing and you think like, okay, I need maybe a portfolio of stocks, then you try and, pick a few names that you think will be winners, names that you think will outperform in the long run. But that's quite hard to manage, right? As we have covered, right? I think you need to have a lot of innate interest in stocks and following the news, going through maybe even quarterly reports, talking to your friends about it. But like, if that's not really for you, you have a very busy life, family, and you prefer to express your interest elsewhere, you rather just kind of invest in a broad basket of stocks, and the S&P 500 or the index is the most popular one that is, right? It represents 500 of the largest US listed companies from not just US, but all around the world. And essentially, it's a very easy way to grow your wealth. And I will show you how well the S&P has done, and also how you could even choose other ETFs other than the S&P. So there are also other ETFs that contain bonds, other precious metals like gold, REITs, for example, other asset classes, and other specific sectors. So when I mention S&P 500, that's just an example, a prime example of what an ETF is and why you would use it over, say, picking stocks. But if you want to really build an investment portfolio, you can put together 2, 3, maybe even 4 ETFs representing different asset classes to build a portfolio, right? So for example, here, if you hold a S&P 500 ETF, you can certainly also hold an ETF that represents gold, that tracks the price of gold. And that will give you, diversification to a different asset class altogether, so that over time your portfolio is resilient. Resilient meaning if stocks take a tumble, let's say if there's certain risks in the market, then gold rises, then you're diversified in terms of the performance. So your portfolio does well over time, as opposed to just kind of putting it all on equities, for example. So that's how powerful ETFs can be, because in just buying 1 or 2 or 3, 4 ETFs, you can already have a lot of diversification from so many dimensions. It's not just like equities from different geographies, but across different asset class as well. So don't take my word for it. Warren Buffett himself, legendary stock picker, also says that like, for most people, he advised them to also use the S&P 500 as their way of growing wealth as opposed to stock picking. He knows how difficult it can be, and actually just investing in the index might help you outperform over time, even compared to investment professionals. And if I'm not mistaken as well, like in his will or in his kind of trust, he also states that a lot of his wealth for his beneficiaries after he passes away will be invested in the S&P 500 as well. So it's something that is very mainstream. A lot of people use it, whether you are an investment professional, whether you're a retail investor, or whether you have a lot of money or you're just getting started. ETFs is a good way to go. And actually, in a lot of ways, passive investing is credited to this guy. This guy's name is John C. Bogle. He's the founder of Vanguard and the index fund essentially, and he's basically the father of passive investing, meaning don't stock pick, just buy the whole index. And as he said, don't look for the needle in haystack, just buy the haystack. Or in other words, don't spend your time picking winners when the whole field is actually quite healthy, right? Like you don't have to risk trying to make 20% if, for example, buying the whole index gives you 15%, right? Trying to go for that one needle in a haystack or that for that one horse to win, you're taking just so much more risk, right? So just to recap this first part of the webinar today, ETFs is a basket of securities, whether it's stocks, bonds, or gold, or REITs, representing an asset class or index, which you can buy in a very cheap way and get instant diversification. So if you think about the easiest, one of the easiest ways to begin, one of the most convenient ways to grow your wealth for the long term, ETFs definitely can help you do that. Now, in this next section, I will go through a few scenarios on how exactly ETFs can help you build long-term wealth, right? So my first scenario here is if, let's say, you have a lot of cash, right? Like, a lot of people here in Malaysia are very cash focused. If I'm not mistaken, there is over 80 billion sitting in cash in banks just for individuals alone, and not even including other things like FDs and money market funds, right? So just sitting in cash is something that a lot of Asian people and Malaysians do as a way of saving and like really, really slowly, modestly growing their wealth. But if you are comfortable with risk and you have a long-term horizon and you do things like dollar cost average, which I'll go to at the end of the webinar, it's much better to have a strong savings, like a cash foundation and safety net, that kind of thing, but also diversify into other equity investments to grow your wealth in a much more profound way, in a much kind of higher way, higher return kind of way, to really, really profoundly grow your wealth. So for example, if you had left your money in FD, and over here I've simulated, if you had just put 100,000 ringgit every year for 10 years, and you put that all into FD, after 10 years, you only have 1.4 million. Sounds like a lot, but your capital that you've put into this FD is 1 million, right? 100,000 is 1 million. So 100,000 over 10 years. So only 400,000 of that, or roughly a third, comes from the interest that you've earned. And here I've assumed a very generous 4% on that average FD over the next 10 years, right? We all know that interest rates are falling. It's not likely that cash or FDs rather would give you such good returns in the future. If you contrast that to, let's say, the S&P, if you've invested in it for over the last 10 years, historical returns don't reflect and don't guarantee future performance, but if over the long term, it's indicative of how it could do in the long run. And anyway, history is all we can look for as a point of reference. So if we look back on the last 10 years, the S&P has returned 15% on average. That means 15% on average every year, because there are some years where it's done incredibly well, like over 20%, also years that it has underperformed, lost money. But in all throughout the 10 years, if you analyze the returns, it's 15%, which is a really healthy return on an annual basis if you compare that to not just cash, but also other things like EPF or ASB or real estate. If you rented out your house, it's also a much better rate than the local market, right? I mean, in the local market, unless you really excel at stock picking and are very astute at stock picking, it's very hard to beat 15%. So if you had put 100,000 every year for 10 years, your capital would have grown to 2.3 million ringgit. And that's because of the much, much higher, almost triple the annual return. 15% compared to 4% is just so much, a world of difference. And I would say also with regards to this, when I talked to you earlier about how a lot of, 85% of fund managers managing large cap stocks in the US don't beat the index, is because it's hard to beat. Like, it's hard to get 15% year in, year out, right? So ultimately, if you're in cash, you only really need around 6 months of your expenses put away, and you definitely want that growing at a decent rate, but nothing beats returns, equity returns specifically, over the long term. So it's something you should think about. And if you use StashAway's ETF Explorer, you can find the S&P 500 ETF there and invest for the long term. Okay, going to the next scenario where you already have a portfolio, whether this portfolio is a Malaysian equity portfolio or it's the S&P 500, or maybe you have a bunch of investments, right? Like whatever it may be, this scenario is for someone who's like already quite well on their way to quite intermediate in their investing journey. They have quite a few investments lying around. But for some reason, if you wanted to further diversify asset classes into other asset classes or into specific sectors or anything like that, ETFs are such a good way of doing so, right? So I've been talking about S&P quite a lot now, but like if I just continue using it as an example for why you would diversify away from the S&P, if let's say you already have it, or you have a US stock portfolio, something like that, you would definitely know that tech companies have risen in value so much so that they are a really, really big part of the S&P 500. You can see here that the tech companies make up 34% of the S&P, meaning even with the S&P, while you are diversified across 500 stocks, the weightage towards one particular sector is very, very high, right? So a third of it is in tech stocks, and that's no surprise, right? I'm sure by now you've heard of Magnificent Seven, right? Companies like Nvidia and Meta and Alphabet and Amazon, really like posting amazing earnings, reaching valuations that are really high, breaching trillions and trillions of market cap. So they actually become a much larger and larger weightage as part of the S&P. So to that, an investor would say, okay, I'm overexposed to a particular sector, whether it's tech in this case. It's a really wise thing to consider adding another element to my portfolio, whether that's another asset class, like in the case of gold, for example, right? Like gold acts very differently to stocks in the long run. They have very different properties. Gold is much more seen as like a quote unquote safe haven asset. When geopolitically things don't go well, people flood into gold, and also gold is seen as like something to in the long, history, right? Like talking about like 20 years plus, seen as something to kind of hedge out inflation by giving you very steady returns like 5 to 6%. But in the last few years, gold has done extremely well. So the average return has been dragged up to more than 10%. But traditionally, gold has been quite a modest returning asset. But anyway, you would consider adding gold into your portfolio through an ETF, because there are also benefits to it as well, right? Like investing in gold through an ETF is a much more cost efficient way, because if you do that through banks, the buy and sell spread is 4%, whereas if you go through StashAway's ETF Explorer, it's only $199 US to buy, right? And that's just a flat fee. So if you're buying 1,000, if you're buying 100,000 worth of gold ETF units, it's only 199. So gold is one great way to complement a equity portfolio, be it a US portfolio or a Malaysian one. It's just such a good way of diversifying. And you can also think about diversifying to another sector. Just for comparison's sake, I just put here oil barrel, just to say, if you, for example, were bullish about the prospects of oil and gas companies going forward, and you think that, I wanted to add my position in terms of adding more exposure to oil and gas, because the S&P portfolio that you have already, the exposure to energy is really low. It's 2.8% only, right? So if you're bullish about oil and gas for whatever reason, let's say you have this thinking that, like, okay, AI is here. We were investing a lot in data centers, and that requires a lot of energy, and it's not easy to get a coal-fired power plant up and running. Maybe there'll be implications or impact on the energy sector. So I think oil and gas stocks will do very well into the future. If you reach that conclusion, then buying an ETF that has exposure to oil and gas companies is one way of also doing it. And then you can also diversify across another geography, right? Let's say because of the political situation in the US, you think Donald Trump is going to, in the medium term, kind of like ruin the American economy because of tariffs or all the disruptive things he's doing. That's just one view, right? Like, I'm not saying that's going to happen, but like, if you think that way, you could diversify, kind of hedge your bets by investing in another geography. And by geography, I mean, you can invest in China, India, Japan-based ETFs that contain stocks listed in those countries, or you could just buy a all equity, all world equity ETF that holds equities of the all of the world's major indices. Or another way of doing it is, you think that, okay, I have my S&P 500, I'm very happy with that. I want to have much more exposure to emerging markets because of whatever reason. Emerging markets have rallied also this year because of certain factors that you think is logical. Then you could also buy an emerging market ETF to diversify. So my point is, I know I elaborated quite a lot, but like, my point is, if you already have invested in something and you want something else to purposely, intentionally diversify, whether it's another asset class like gold or bonds or REITs, whether or not it's another sector like oil and gas, or let's say consumer, or let's say banks, right? Whatever sector that you think would do well in the future, you could also consider that. Or if you want to diversify through geography, whether it's country, region, or the world, you can certainly do that. Okay, what if you're worried about markets? What if you think that, let's say, I don't think that the party will continue. I think the recent volatility is makes me very anxious. I retire next year. I'm already 54 years old. I don't want to take so much risk. I want to switch away from kind of broad equity exposure into something much more stable. So what I've done here is I've plotted the S&P against global bonds, global mixed bonds across corporate and also government. So this ticker here is the ETF ticker for global aggregate bonds, AGGG, aggregate. And you can see here the green line is much less volatile. You can see that this is an asset class that is much more stable. I'm sure all of you here have heard before that, like, bonds are very stable. They give you, they are IOUs, and they give you these coupons from the borrowers that have borrowed money. So it's a very stable investment. And yes, it's very stable, and the returns are also very modest. You can see here, this year to date, it's given its return to investors 3.8%. And if you contrast that to the S&P, which has given year to date about 15-16%, you can say, like, yeah, it's much more it's much less of a return, but ultimately you're talking about an asset class that's much less volatile. It doesn't move as much. So if I wanted to switch out of something risky into something safe, I would consider bonds, right? So if you look at S&P during Liberation Day in April, when Trump made those announcements, you can see that actually the S&P was down almost 15% at that point in time. From peak to bottom, it's definitely more. And I don't know how many of you in April would have bought more of the S&P 500. Some did, some didn't. Some panic sell as well. But what I'm saying is, if you're really uncomfortable with the volatility of your portfolio because you're too exposed to equities, you can shift some into bonds, or you can choose to put more money into bonds when it comes to investing more. So you don't have to sell your S&P holdings. You just have to kind of, like, when you're putting in new money, you just put it into bonds, so your portfolio has much more safety overall. So we've gone through 3 different scenarios here. If you're in cash, yielding only 3 to 4%, it's much over the long term, it's much better if you took some equity risk, and as long as you can stomach the risk and you are patient because you invest over a long term, investing in equities through ETFs, it's a good way to go. If you want to diversify beyond something you already have, ETFs are a great way of doing it. If you want to take risk off the table, you want it to be more conservative and switch from equities to bonds, or you wanted to diversify and kind of make your portfolio overall more stable by buying bonds, that's also the way to go in terms of getting ETFs into your portfolio. So with that said, I wanted to show you, give you a little bit of a showcase of what ETF Explorer looks like and how you can transact with it, and how you can maybe even make your first transaction today. By a show of hands, has anyone seen the ETF Explorer within the app but haven't deposited yet, haven't invested yet? Yeah, a couple people. Some of you very shy. Yeah, a few. So you've seen it, you may be a bit curious, but you don't really know how to use it. So ETF Explorer is, for us, a way to buy 1 or 2 ETFs in a really easy way and in a very cost-effective way. We want you to find your investment idea and make a transaction to essentially invest in your idea and hold for the long term. So we want to make it very easy. So you will see that we have over 80 ETFs. Like I said earlier at the start of the webinar, actually, there are over 4,300 ETFs listed on the US exchange. So it can be very daunting. It can be very confusing to go through the whole universe of ETFs by yourself. So what we've done is we've really done all the hard work for you, and we've curated only the ETFs which we think that is worth your time looking into, right? So if you look at some of the equity ETFs that we've made available, you can see here you have different sectors, different indices, you have different geographies as well. So there are a lot for you here to choose from in the form of equities. You can go from the S&P 500, the conventional one, to the Islamic one. You can go into different sectors like semicon or uranium companies, like mining companies. You can go into Chinese tech companies, for example. Or if you want like geographies, you can also choose global equities, like buy all of the equities from developed markets. And as I've said earlier as well, there's also bonds. So if you search by different asset classes, all of these will come up, from very short-term treasuries to long-term government bonds to corporate bonds across developed and emerging markets. You can definitely find bonds for you. There's also a Sukuk ETF over there. So you can choose from this curated list of safer, more protective investments. And if you already have equities and bonds and you want to diversify further, you can look at precious metals, so like gold and silver, which have done very well in the last few years, and also REITs, which also are very safe, kind of stable investments for you to consider. Just a special shout out to those of you looking for for Sharia exposure as well. Here are some of the ETFs that we have available in ETF Explorer that are Sharia compliant. All you have to do is filter by, there's a filter, and then you just click the Sharia one, and then all of the Sharia ones can come up. So you have equities, the US equities, world equities, you have bonds, right? Islamic bonds like Sukuk, precious metals, and also crypto. So I wanted to show you this over here. Let me just adjust this speed. It's actually scrolling through too fast. So let me play this again. So here's the home screen of ETF Explorer. You can find it by heading to the invest button over here at the bottom. And then if you find the pill over here, ETF Explorer, you can see this screen over here. So here, this is the home screen of the ETF Explorer. And then if you click inside, it will lead you to essentially a carousel, which has our top picks and also a long list of other ETFs. So at the top here is 10 or so ETFs which we've chosen for you to consider. We've highlighted it a little bit more than the others because we think that represents a good investment opportunity, or an ETF representing an asset class which should definitely be in your portfolio, in anyone's portfolio, like gold or the S&P. You can also find different sectors that are doing quite well right now, like semiconductors and also the tech space. And then at the bottom there, you have the long list of ETFs. There's 80 of them, so you can see, if you wanted to browse through all of them, we have clearly indicated, the what kind of asset class it is, the risk level, which is very important because you want to know whether you're buying something that is high risk or low risk. And if you're someone seeking higher returns, taking higher risk for the long term, that's something you should look out for. And inversely, or the opposite, right, where you want something safe, if it's like, oh, the returns look really good, but it's too risky, too volatile, then you maybe want to opt out of it and choose something else. We also put the 1-year returns and the 5-year returns. And what we've done is we've analyzed those returns so you can actually do some comparisons and benchmarking more easily, because we don't want to portray information in a misleading way. For example, we don't want to put like total return over, especially here in this card over here, we don't want to say like, oh, the S&P Islamic ETF has done, 300% over the last 10 years, right? I think that's very hard to benchmark. So we've actually analyzed the returns over here for you. And if you scroll through, I'm sure you can find something that would pique your interest, or something that you've heard about before, and ultimately invest in it as well. So you see here at the bottom, there's filters, and then there's sort by, right? So let's take a look at that. Here are some screenshots of what that would look like. So you can choose from different names, different symbols. If you heard from your friend or you did your research and like, oh, I want to find QQQ, you can sort it by that, sort it by returns, sort it by risk. That allows you to rank the different ETFs and make it easier to find. And then once you click into those cards, you will essentially be presented with this, which features the ETF that you've chosen to do a bit of a deeper dive. So we spoke today at length about S&P. You can see like the different logos over here, what's inside the index, the annualized return over the last 5 years, how many stocks it actually holds, and how low the expense ratio is. So the expense ratio is the fee that the ETF issuer charges. It's kind of embedded in the buy and sell price. So whenever you buy and sell, they will charge it, and it's already in the sell price when you come out of it. And this percentage is per annum. So that's actually very, very low. And then if you, for example, you look at the semiconductors ETF over here, it's a specific sector. that features 25 of the leading semiconductor companies that are fueling the boom in AI. So you can see that over the last 10 to 5 years, it has done 28% annualized, representing 25 companies, and the expense ratio is also very, very low, right? 35 basis points. You can buy gold. This is the returns over the last few years and how cheap it is as well. Yeah. So all in all, very user-friendly. And then all you have to do is click continue, which basically allows you to then buy this ETF, and then you can just put in, let's say, how much you want to invest, let's say 5,000 ringgit, and then that's it. If you're already a StashAway user, you know how easy it is to create a portfolio and fund it as well. So it's no different to this. And then I just wanted to spend the next minute talking about dollar cost averaging, because I think that a lot of you here are long-term investors. You've already been on a journey with StashAway. So ultimately, when it comes to buying ETFs, even though it's a single ETF, you can think about dollar cost averaging in it as well. You probably have a portfolio like our general investing portfolios, which has like a bunch of ETFs, right? And some of you dollar cost average. It's no different when you have an ETF, whether it's the S&P one, the gold one, or some bonds, real estate, whatever ETF it may be. Buying, investing over time definitely helps you, because that means that you don't risk going in at the top, so you kind of average in at different prices. And if, let's say, there are dips in the market, you actually can pick up some units for relatively cheaper compared to when it was higher. And then if you continue doing this over time, you'll find that it lowers your entry price, so that you can actually accumulate more units or ETF units, right, over time. So for example, this is just an illustration. Like, for example, if you invested 6K all at once at $2, you would basically only get 3,000 shares over 6 months. But if you divided if you broke up your deposits over 6 months, you can then use that to make different entry points with different values. And actually at the end of 6 months, if the graph looks like this, for example, right, the graph could look very different, but if this graph looks like this, meaning you accumulate some at less than $2, you actually end up with more shares at a lower average price as well. So dollar cost averaging definitely helps you invest for the long term, because if you had 1 million to invest today, you can certainly do so if you have a very long-term horizon, 5 years or more. But if you get a monthly salary of, let's say, 20, 30,000, 10, 15,000, whatever it may be, you want to slowly average into markets this way. So dollar cost averaging is definitely one way to help you reduce your risk of entering the market at the peak and kind of accumulating accumulating units at different points in time. Okay, and as a reward for sitting through this webinar, we also wanted to give you a little bit of an incentive to try out ETF Explorer. So if you put in the promo code ETFXTRY, ETFXTRY, into the field, under promotions and campaigns, you can basically make free buy orders for all of December. And I think going through the T's and C's is definitely a good thing. So maybe I'll just caveat by saying that this only applies for fresh funds. So if you deposited from your bank account, fresh funds, then you become eligible for this. You definitely want to apply the voucher code before depositing. And if you choose to sell, there will be fees. So, it's a fairly new product. We want to see people try it. So that's why we are incentivizing buying, right? So like if you buy any one of the ETFs that we talked about today in December, it will be there'll be no transaction cost. So if you go to your promotions, if you click on promotions within the app and you enter the promo code ETFXTRY, you will get free buy orders until the 31st December. So consider this a little bit of a Christmas treat from us. a little bit of a treat for tuning in today and learning a few things about ETFs. And this is something that you can just take a screenshot and then try later on when you make your first deposit on ETFX. And for those of you who already use ETFX, if you apply this promo code, you can also benefit from free buy transactions all of this month. So with that, I certainly hope that you enjoy this. Okay, so I see a few questions here, and I will attempt to answer them. And you guys, thanks for the questions. And for those of you who haven't asked any questions, feel free to do so in using the Q&A button as well. Okay, so first question is, what's the difference between buying gold ETF and buying gold, like owning the asset? I will say from a purely investment standpoint, no difference. Of course, some people like buying gold because they like the physical asset in their hand. They feel very safe. But in terms of the price of the gold, is exactly the same. So if we're purely talking about, non-jewelry, right? We're talking about like little bars and little coins. The physical manifestation of gold is just something to hold on to, maybe put in a safe deposit box. But like if you're talking about buying gold ETF versus buying physical gold, and those two things follow the price of gold in the market, is exactly the same. In fact, buying a gold ETF is much cheaper. I think buying it through the bank or owning it physically is very expensive because of the buy and sell spread. So when you go to the foreign exchange dealer, you see the buy and the sell spread, right? And they also buy low and sell high, and they make a margin from that. And if you divide the sell from the buy, it's actually 4-5%. And this 4-5% is basically the cost that you're paying. So if you buy a gold ETF on StashAway, it's only $199 US. So let's just say around eight ringgit. And if you make a investment around 1,000 ringgit, or let's say 5,000 ringgit, let's calculate that. That's only 0.8%, in terms of a fee. So if you invest 1,000 on using ETF platform, the buy is only 0.8% versus 4%. So it's like not even 1%. So it's like so much more cheaper, like 4 times cheaper than buying it at the bank. So just to recap, it's much cheaper to use ETFs to buy gold. And in terms of the gold, following the price of gold in the market, it's exactly the same. Okay, so another person asked a really good question is, what's the difference between buying unit trusts and ETFs? The fundamental difference is that a unit trust is a fund that the fund manager manages, and he's making active decisions every day to try and beat the benchmark. Whereas for the most part, ETFs are a passive vehicle. If you buy the ETF, like that's S&P, whatever the S&P does, that's what you will get. But a unit trust fund manager is trying to beat their benchmark, whether it's the S&P or whether it's a Bursa-based kind of benchmark. You're really looking at the difference between an active investor and a passive investor, right? So I would say that ETFs are a much better way to invest because they give you really good returns. As I've shown you, some of these give you really good returns. It's no less riskier than a unit trust of the same risk, right? Like if you're talking about an equity fund, you're looking at equity risk to equity risk. And unit trusts are just so much more expensive, right? The upfront fee is 3 to 5%. If you're talking about equity fund, the management fee is 1.5 to 2%. Whereas buying an ETF, like I said here, 199, that's it. 8 ringgit to buy, 8 ringgit to sell, and that's it, right? Like whereas if you buy unit trusts, you have to pay the management fee every year, and you have to pay the sales charge every time you invest. So it's much more expensive using a unit trust versus ETFs. And at the end of the day, they're both vehicles to grow your wealth, but one is so much more low cost. Yeah. Okay, Marcus says, in the current market, are there any particular sectors or geographies that StashAway is recommending for the next 12 to 18 months? So 12 to 18 months is, I would say, a moderate period of time. It's actually quite a short period of time. So let me interpret Marcus by saying that you're not going to definitely sell between the next 12 to 18 months, right? So I would say if you're holding for a longer time period, say 3 to 5 years, if you're looking at the S&P or the NASDAQ or the semiconductor space, I think the AI revolution is just kicking off. I think everyone is asking if it's expensive because of all the news that is coming up and all the valuations that we're seeing. But we're actually seeing the underlying, the companies that are the hyperscalers, for example, like really delivering really good earnings. Like Nvidia is like still posting very solid earnings, and there's a talk about AI bubble and all that kind of thing. And it's here at StashAway, we don't think so because the earnings are still there and the business models are quite well defined as opposed to the dot-com bubble back then. And in terms of valuation also, it's high, but it's not like ridiculous. So we think that there's room to run anything based off on the AI. Another question asked is, for the promo code, what if I move the money from StashAway Simple into the ETF? So that doesn't apply. So we are talking about fresh funds that you bring from bank account. So Sam asks, could you elaborate on how tracking error and liquidity risks differ between physical and synthetic ETFs and how retail investors can evaluate these things effectively? So Sam, I think, tracking, let's just define it first. So tracking error is basically how much slippage, or like in the word here, error, that the ETF actually has against underlying assets. So when you're talking about the S&P, for example, the index is replicating the price action of and weightages of these stocks, right? And it's just doing so through like a formula. But when you actually have to issue an ETF, buy these 500 stocks and do it according to the size of these stocks, sometimes there's slippage, right? Because when you do adjustment and all that, the very large ETFs have very, very low tracking error, close to zero. So if you have two ETFs that represent the same asset class, but one has a higher tracking error, meaning there's like some difference in the price, it's not necessarily like a good thing or bad thing, especially if it's small. It's just more like if there's tracking error, it means there's some inaccuracy. So it could actually overperform or underperform by a certain amount. Yeah. So if tracking error is fairly low, and that is definitely one of the criteria which we use to list some of the ETFs we have on offer here. That's how that's essentially one way of like curating these ETFs, right? We find some that are low tracking errors, and then liquidity risk basically just means that like how much volume on an average day is there readily available if, let's say, you want, StashAway wants to sell on your behalf. So if you say you're talking in the extreme case of having like a ETF that trades something very exotic, let's say diamond mines, right? Like, and diamond mines, not many people trade the ETF. If you try and sell a very large position, you'll be very hard, and unless you go down in price, there's no one to buy your ETF. So liquidity risk is also something that professional fund managers look at. We certainly look at it as well, because it's much, you don't have more slippage in terms of selling into a illiquid market. So we definitely want to have a liquid market. And then you're talking about physical and synthetic ETFs. Like, look, all the ETFs here we have on our platform are all backed by actual securities. So they're all physically backed securities. We don't trade any CFDs or any derivatives. So basically, we have curated a list of low cost, high liquidity, low tracking error, tax advantaged ETFs, and they're all backed by the real stocks, bonds, gold, and all that. So you don't have to worry about it. Chicken asks, what's the benefit of buying ETFs through StashAway compared to other platforms? So I would say that we make it very easy for you. Maybe somewhere else is cheaper, but I would say we make it very easy. And for example, if you don't wish to trade stocks, you shouldn't need to operate a brokerage account. The reason why we launched this ETF Explorer is because we saw like some of our customers actually, like, they're very happy with their portfolio, but then when we launch flexible portfolio, they'll buy one or two ETFs to express a specific view. So whether it's the S&P or whether it's gold, they just like want to buy more of a specific ETF. They did it through us. So we developed a whole new product for people to buy singular ETFs, right? And we think that also for new investors who don't use our other managed portfolios like general investing and BlackRock and things like that, it's fine because they can just buy ETF that we have curated and shortlisted for you, and ultimately you can um, build your wealth through ETFs this way, right? Who owns these ETF platforms? Will the fund manager fail or go bankrupt? What are the risks? So, so when we buy these ETFs on your behalf, we are the fund manager. So you will still own these ETFs through us, StashAway. So if StashAway, touch wood, goes bankrupt, the liquidators will basically sell these ETFs at market price and return it back to you at the price that they sell at. So obviously it won't be seamless in the sense that we will have to go through an administration process, stop taking orders, and then see how many people, which person owns how much ETFs, and then we'll return the money to you. So you're not taking credit risk on StashAway. So if StashAway fails, your money will be returned to you after going through an administration process. Obviously, that's not something we want to go through, but it's a good question in terms of asking. It's a good question in terms of asking what will happen in the worst case scenario. Okay, Mark asks, the fee per order is $199 US, which is a large percentage which can impact returns significantly. If we want to dollar cost average low amounts, any advice for investing smaller amounts? Yeah, Megan. So, sorry, Mark, I think it's all a matter of perspective. If let's say you're investing 10 ringgit, and if the order fee is 199, of course, that's a very large percentage. But if you invested 1,000 ringgit, which we think is actually quite a small order if you compare it to brokerage platforms or things like that. Yeah, I think advice for DCing smaller amounts, it depends on how small you want to go. I would say if you dollar cost average when you have a few hundred or at least 1,000, then you can go from there. Yeah. Naomi asks, what is the currency conversion on global ETFs when we buy and sell? So the currency conversion spread or fee is 0.35%. So if you add up your total cost to buy, it's $1.99 and 35 basis points on your investment. So if you added that all together, that's still around 1% if you're making a 1,000 ringgit buy transaction. So it's actually still very, very low. If you compare our FX buy and sell spread to other brokerages or, God forbid, banks, they are much higher. I can say, I won't name the company, but if we look at some of these digital brokers, their FX spread is double from StashAway. So we try and optimize all these costs, and ultimately we're trying to run a business. So we have to make money from various ways, right? And actually, I would say also we are doing the right thing by offering you a transaction fee as opposed to a management fee. So there was feedback, for example, when people were using our flexible portfolios and they were buying one ETF. So with that one ETF, we would charge 0.8% a year. So it's every year they pay 0.8%, no matter how much they bought, right? So if let's say you buy and you never sell, let's just say hypothetically you just never sold, you pay us once. That's it. So every year, we hope that you dollar cost average. We hope you build your wealth through us. We hope that you buy a few ETFs. But we understand where the investment landscape is heading, and we want you to get the most value out of our platform, even if, of course, we are still running a business. So we think that 199 is still really low, and we think that our FX spread is rock bottom. And ultimately, we're not trying to cheat anyone here. We're not trying to load very expensive things onto you. As a digital platform, we hate high fees, and we think that this is a sustainable way for us to grow, get more customers, serve them in a very good way. Okay. Thank you very much for those questions, Naomi and Mark. That's it, guys. So I hope you enjoyed today's conversation. If I can just recap, I think that ETFs are not new. If it's something that is new to you, know that it's been around for a long time. It's actually a very mainstream way of investing. And if you're very intimidated or you don't have the time to stock pick, then ETFs is definitely the way to go, because you can just get passive exposure to an index or a few asset classes, few sectors. So getting started is really, really easy. And whether you're in cash and want to start investing, whether you've already invested and want to diversify, or whether you're already invested and you wanted to take more risk or less risk, ETFs is a great way of expressing your investment direction. And then obviously we think that ETF platform the ETF Explorer is a really good way to get exposure to the ETFs that you want, because we've already made the list so compact. We've really distilled through thousands and thousands of ETFs. So the best ETF represents that asset class, right? So there's numerous S&P 500 ETFs. There's numerous bond type ETFs. We've picked the best one for you based on expense ratio, liquidity, tracking error, taxes, all of that, so that you can just invest with ease. You don't have to be an investment analyst and do all these comparisons between the same ETFs, right, on all these platforms. So we made it very easy for you, and we hope you try. The promo code is ETFXTRY, ETFXTRY. So if you do it in December, I think it's a really good way of starting your investment journey through ETF platform. And we'll be here for you with with webinars like this, right? We'll talk about markets, we'll talk about how to use these platforms and help you along your investment journey. So good luck to you. Hope you enjoyed today. I'll see you guys in the next one. Thank you. Bye.